Hello, everyone. I hope you are doing great. Today, I'm going to do live analysis on a triple Q. So, to have a better idea about what's about to happen in the next 4 weeks. Before starting, I would like to know if you have my voice clearly. So, I will do a quick check with you guys to see if you having my voice. So, fortunately, you have my voice. So let's go to the analysis and see what we are having and what could be the most possible forecast for the next 4 weeks. Before we start, I want to read a quote from Jim Simons, who's like the god of the quantitative trading. He has a famous quote about randomness in the market. He says, patterns of price movement are not random. However, they are close enough to random so that getting some excess, some edge out of it is not easy and not so obvious. Thank God. God probably doesn't care. Thank whoever. So, first, I would like to make a comparison between what we are dealing after November in the market and what has happened before that. As most of you know, after the pandemic, we had like one of the craziest market ever at that time. Although market was up after like 37% crash in less than 1.5 months, it bounced back, experienced the best 100 days ever in the market, and increased more than double. As you can see here, market wasn't really random. The number of the green candles clearly exceed the red ones, and the direction of the market was super clear. Then we had a short time period of a correction between September and October. September classically is the worst performing months ever. You can see my analysis about this on TradingView. In the past 70 years, September has the worst performance among the other months in a year. Then you see it started by a holiday in September, and when the market went down, and after that we had a sharp rally up to the early November. But in mid-November, the famous Jerome Powell a speech about the possibility of increase in rates actually pushed the market first down, then to the sideways. And by the beginning of 2022, you see market experience a sharp drop. In the first 3 months, it was like the worst first 3 months ever in the past 120 years. We experienced a relief rally, which was sharp, around 19%, and then another plus 20% drop very sharply is obvious. So if you can see it here, I mark this zone as twilight zone. So the twilight zone in George Soros market theory and bubble theory is when the regime change happens. So it usually happening after a very radical bullish rally. And at this point, at the twilight zone, investor, according to George Soros, investor becomes skeptical and bearish. The disconnect between asset prices and fundamental recognized by some investor will slow down the market appreciation rate. So will slow down the market appreciation. At this time, me and some other analysts talk about like the PE ratio of tech and the market is more than twice as the usual. It was around 29. As most of you know, the average market P ratio is around 15, between 15 and 16. So today we are talking about, we are around 2021. So we can say a lot of the bubble deflate for now, but let's see what is happening if the rates keep going up. The most important thing about this part of the market is that we are facing rate hikes and the inflation rate which are not common in the past 4 decades. So we are facing the highest inflation ever in the past 4 decades, and it is not peaked yet, and it's not slowed down. And Fed and Jerome Powell told us they are keep increasing the rates until positive rates. So what they define as their main mission is controlling the inflation and highest employment ever. We have like one of the lowest employment rate ever. The job market is tight. There is 2 opportunity for every job-seeking American. At least in US, the job market is doing good. So they have their full ability to increase the rate as much as they want. And market will be the collateral damage. So the bearish market for them is not important at all. And some people may think this is really their job to keep the market up, but they do not believe in something like that. So the monetary policy is actually, they are trying to push the employment and the inflation, not the markets. Markets are reactive to their decision, and that is the thing. So these are like the fundamental behind the bearish rally we are experiencing. Now let's go to some technicals. If you are looking at this zone, there is something important about it. After a sharp drop, we usually experience a relief rally. So sometimes this could be a V-shaped rally like this, or sometimes it could go sideways. So usually if we have one sharp, the other tends to go sideways. I want to compare this part with this part because if you are looking at this, we had a sharp rally followed by a V-shape down, then V-shape up, we went sideways, and then we go down, V-shape up, V-shape down, and it is highly likely that we go to a sideways. And other evidences support this possibility. How? Let's talk about it. So if you are looking here is like the volume. If you want to talk about the NASDAQ 100, we actually don't have the volume to talk about, but talking on the triple Q chart makes much easier for us to talk about it. So if you are looking in the first phase, we had very high volume. Then you see this relief rally, which has very lower, like 40% lower volume compared to this one. And if you are looking at the average, it's completely obvious. Then you see the second leg down. So if this is the second leg down, you see increase in the average trading volume. So sellers were strong enough to push the triple Q much lower. If you are looking, something happened in the second half of May until now. The average volume is actually go lower, much lower, and it's like below the half of this, or like 40% lower than this. If you are looking at this volume, it shows that from May to today, from May 12th to today, we have almost no change. The highest level of today is almost equal to the lowest level of May. So the market actually started going sideways, that we can see in other slide as well. In this slide, what I talked about, you can see that market has made a range between, it depends. If you calculating from top to down, it's like 14%. If you're calculating from down to top, it's like 16.7%. So it's like a 15% range market. What are the features of the range market? One of the most important features of the range market is that prices tend to make like a smaller moves. As you can see here, the number of dojis increased relatively to the big candles with big bodies. So if we want to talk about dojis, dojis are small candles. The body of the candles are small, but the shadows are, or the wicks are longer than the body. So if you are looking, for example, here between June 30th to July 1st, which is like the past 2-3 weeks, if you are looking, we see only 2 candles with a big body, but the others are very small. If you are looking, the body of other candles are very small. However, the wicks, the upper wicks like this, or the lower wicks like this, are increasing. Some of them like this have upper and lower shadows. We call them spinning. So if you are looking at these, this is one of the reasons that I don't publish so many trading ideas, because market is trading in a range. We should wait for one of the edges to be touched with the price and then enter the opposite side when the market is trading in a range, like narrow range relative to the previous moves. And for day trading, actually, and option trading, these candles are killers. If you try to trade option in these days, the chance of losing money is much more than chance of making money. Because if you are looking, the market, for example, here or here or here, started from somewhere, go to the one direction, then come back and move down and then back up again. Or here, up, down, up again. So this is like here, you barely can make money unless you are trading like very fast, like in 1 hour charts. I will show you the 1 hour charts so you become much more familiar with that, and you you have like a better chance to see how market behavior has changed during the past 4 to 6 weeks. So one other important thing that I would like to talk about is the rate of change. To me, the rate of change is more important than the change itself. If you are looking at the market from the beginning of 2022, you see that the rate of change become negative and remain negative except for 6 days in April. So if you are looking at the rate of change of the market I usually use 50 days rate of change and 50 EMAs. Most of you know this by now. So if you are looking at this, you see in most of the time, the rate of change is negative. The highest rate, the negative rate was mid-March with minus 20.54%, and then in the second leg it was even worse, and market went down 24.85% in a 50-day time period. What is now interesting is that we see some deceleration in the rate of change. So the rate of change, as we are talking, is around 17.5, which means the rate of change and going down has slowed down in the past 2-3 weeks from here to here. So I expect if this continue, we could have a good chance to reach the upper resistance border like this between 300 to 314 or around that by July. So this is my forecast for now, because the trend of this actually has changed. Now you see some divergence in the rate of change. This divergence in the rate of change, if continue, could push this upper to the upper border of this range that I talked about before. So there is a good chance that we move toward the upper border. But there is another important thing that we should keep in mind. In the next 4 weeks, next 4 to 6 weeks, we are going to have the earning calls for the big techs. The most probable scenario for most of them, I believe, is that they are going to have like good EPS covering. However, most companies are going to lower their forecast for their earnings in the coming quarters, which could affect the prices negatively. One good example for that could be like Micron Technologies. A couple 2 days ago, as you can see, the earning was better than the expectation, but they lowered their forecast in their coming earning. I believe this is going to happen to many other important tech industry, especially after AMD followed by Micron Technology and mentioned the orders for new orders and customers actually decreased severely in a very short time period, because many forecasts shows that we are moving toward a recession. So lower request for chips could be like a very good indicator. And when semiconductor, which is like the leading market and have like trouble with having more orders, this I think is very important, and we should take this into consideration that the risk of recession could increase in the coming days or quarters. So that's it. That's my forecast for the market. I believe in short term, like 2 to 4 weeks, there is a good chance to move toward uh, upper levels of this zone. So, and then there could be another leg down after that. So this is if you want to know more about this, you can check my previous NASDAQ analysis. I hope you enjoy this. I will prepare the video and share it on YouTube. You can also subscribe to the YouTube channel. If you like this analysis, you can write your comments. I will try to answer all your questions in Telegram, Patreon, and YouTube. So thank you for listening to this analysis. I hope it will help you to have a better idea about what's about to happen in the next 2 to 4 weeks. Thank you so much.